based in Markham, Ontario, Canada. TE Technologies Incorporated is one of the world's largest makers of computer graphic chips and boards. The company listed publicly in 1986 in Toronto Stock Exchange under name TSX. In February 1999, the share of company was around $12. My boss, who invested in the stock, told me to check the share price for him every morning because the value of share increased steadfastly. The share price increased from 12.10 to 12.80, then 13.05 within a week. After a week of hesitance, I bought my first share of the company in February 14, 1999, although I didn't know anything about stock market, and I didn't buy any stock before in my life. 1999 was my first time I participated in stock market. In 1999, the stock market at upswing trend was a period of excessive speculation, known as a tech bubble and internet bubble. The Nasdaq Composite Stock Market Index, which included many internet-based companies, peaked at 5,048.02 in March 10/2000, before crashing. Nasdaq index fell roughly 80% before bottoming out around 1,000 in October 2002. At the end, my first-time investment in stock market suffered a heavy loss. A big chunk of my saving has been wiped out. I have to pay a very stiff price for the lesson of investment in stock market. There are few things I wished I knew when I started investing in 1999. 1. Don't be greedy. Stock market is very attractive because of the pretty returns that it gives. Everyone wants to earn money easily. Who don't want to make a lot of money in less time? Nobody can predict the markets accurately, therefore if investor gets good returns, he should book the profit immediately. Don't keep all the share in the market after a substantial gain. Take profit by sell 50% of the shares and keep 50% of the shares in the market to let market run. Stock prices never go straight down or straight up, but rather in zigzag pattern. Scale out is the process of selling portions of total held shares while the price increases. To scale out means to get out of a position in increments as the price climbs. This strategy allows the investor to take profits while the price is increasing. Scaling out protects the profit you get, thus reducing the risk of missing out on profits if the price did drop. Don't become a greedy trader that keep all the share in the market with the hope of being a big winner. The big gain in the market is only a booking profit, a gain in the paper. The real profit is the amount of capital in the account. The good rule of investment in stock market is scale out of positions after they gain substantially. This technique reduces overall profit because, of course, investor would have made more if you had left the entire position open for the duration of the entire upward move. However, scaling out protects the profit investor have. Have you ever heard the old Wall Street maxim that warns against greed? Bulls make money, bears make money, pigs get slaughtered is an old Wall Street saying that warns investors against excessive greed. Rule 2. Preservation of the capital. Capital preservation is a strategy for protecting the money investor have available to invest. Depending on the investor's risk tolerance and the fund available in the account, investor should decide beforehand how much money he wants to lose. If the loss reaches the preset level, he should liquidate the share immediately without any hesitation. without cutting your loss and let the market runs against you. The risk of margin call is unavoidable. The end result is you lose all your fund in the worst case. Cut the loss and let the profits run is the golden rule of investment. Investors must learn how to cut their losses short. This means selling a stock when it's down 7% or 8% from your purchase price. Sounds simple, but many investors have learned the hard way how difficult it is to master the most important rule in investing. No one wants to sell for a loss. It's an admission that you made a mistake. You have taken a small loss to preserve your account to invest the next day. Cutting losses quickly prevents you from suffering a devastating fall that's too steep to recover from. Rule 3. Know when to buy and when to sell. Market timing is the controversial subject. Many investors, academics, and financial professionals believe it is impossible to time the market. Other investors, notably active traders, believe strongly in it. Warren Buffett once said that as an investor, it is wise to be fearful when others are greedy and greedy when others are fearful. When others are greedy, prices typically boil over, and one should be cautious lest they overpay for an asset that subsequently leads to anemic returns. When others are fearful, it may present a good value buying opportunity. Market timing is not impossible to do. Here is the quote from 2004 annual shareholder letter that Warren Buffett wrote. And if they insist on trying to time their participation in equities, they should try to be fearful when others are greedy and greedy only when others are fearful. Investing in stock market is long-term approach. Investors have to be patient to time their participation in equities. These predictive tools include following technical indicators or economic data to gauge how the market is going to move. The combination of fundamental analysis and technical analysis should give idea of when the price of security is low for buying opportunity, or when the price of security is high for selling opportunity. Technical analysis is hard to learn. Besides, if you want to trade forex, knowledge of technical analysis is a must. Financial literacy is essential skill should be learned if you want to be rich. Spend less than save money to invest. Let money makes money like all wealthy people do. To sum up, here are 3 important rules that investors should keep in mind when investing. In stock market. 1. Don't be greedy. Scale out the position to keep profit after substantial gain. 2. Protect your capital. Cut the losses short. 3. Investing in stock market is a long-term approach. Be patient for the opportunities to buy or to sell.